I want you to imagine for a moment that you started investing back in mid-2009. For over 10 years, the stock market keeps going up, driven by world-changing innovations and technology. And you're making more and more money. Until
stocks set to fall at the open as futures overnight hitting their limit down levels once again.
This is the fastest 12% loss in
Here's
history.
the circuit breaker, 25.49.
The Dow just had its biggest point drop in history.
Retailers, restaurants, airline, travel, leisure.
The global economy is expected to contract by 3% in 2020, the worst recession since the Great Depression.
Up until now, you looked like a genius to your friends and coworkers, but now people around you are telling you to sell. They say the market was all a bubble and stock prices today are driven by hype and greed rather than new innovation and valuable products. But you ignore them, and very quickly the market recovers and rises even more until
stock market free fall. The more than 1,000 point plunge today after the Fed announced the largest interest rate hike in 22 years.
People are begging you to exit the market, saying it's time to take your profits before you lose everything. Innovation is dead, and we can't rely on technology to drive prices any higher. But you hold through the roller coaster, and since then, the market is up another 61%, driven by huge advances in technology such as AI and optimism for what is next. So you can probably guess, but that investor who first bought stocks back in 2009 was me, a teenager who was obsessed with the devastation caused by the financial crisis of 2008, where I had friends who had to move away because of some Wall Street banker far away. The average return since 2009 in the tech-focused NASDAQ was around 16.9%, meaning if you invested just $250 per month over that time, you'd be sitting on over $169,000. But even that is a short time in terms of stock market returns. If you'd invested for the 40 years that the average person works, starting in 1985, you would have over $2 million, which is a return of just under 7,500%. That's $2 million without hitting the lottery, finding pirate treasure, or accidentally inventing the next fidget spinner. So now that you understand the power of investing, I want to use this video to go over what I would do if I were starting to invest in 2025. We'll go over what I would buy, why and how, including the trends that drove the market in 2024, the two most important investments for the next decade, my philosophy of investing framework, some common fears and questions around investing, and we'll wrap it up with my one rule for picking stocks that I wish I knew when I was first getting started. And I'll have lots of free resources linked below for anyone who wants to go deeper. But let's just start with, what would I buy? So we'll start with part one, the trends that drove the market in 2024. So for the last 3 years, there has been one trend that has been dominating the stock market.
Artificial intelligence.
Artificial intelligence.
Artificial intelligence.
AI stocks were the biggest success story of the past few years, with companies like Palantir seeing a 350% increase in price in 1 year, which was great for those of us who got in early. In fact, AI stocks were so dominant in 2024 that they drove most of the overall stock market's rise. The S&P 500 just completed its biggest 2-year gain in history, rising over 50% in value during that time. If you put $10,000 into the stock market at the start of 2023, you would have made $5,000 by just sitting back and letting your money grow for 2 years. And if you had invested more, say $100,000, you saw some insane profits. So that's actually our first option for what we could buy. We could just invest in the S&P 500. See, the S&P 500 is an index, basically a basket of stocks that you can buy all bundled together. It represents the 500 biggest public companies in the United States weighted by their total value. And seeing as it's up 50% in 2 years, it's pretty tempting to just throw 100% of your money into that and call it a day. But the index's spectacular rise masks the real trends that have been driving those gains. See, in recent years, the S&P 500 has become more and more concentrated in just a few stocks. It's like a group project in school where 1 or 2 people are doing all the work, and if those people didn't do everything, the project would have probably fallen apart. Apple, Amazon, Nvidia, Google, Tesla, Microsoft, and Meta. These 7 technology stocks are some of the biggest companies in the market, and collectively, they've become known as the Magnificent Seven. They've earned this name because these stocks collectively have risen over 70% in the past 2 years, and collectively collectively, these 7 stocks now make up more than 1/3 of the entire value of the S&P 500. Like, for scale, these 7 stocks' rise in the past 2 years is worth more than the entire value of Japan's GDP. This concentration, where only a few stocks drive most of the value, explains why the stock market seems to keep marching higher even while many consumers feel uncertain about the overall economy. But it also gives us our second option for what to buy. We could go even more concentrated and just pick a few of the top performing stocks from the last few years to invest in. These stocks touch on AI, blockchain, augmented reality, quantum computing. So if these stocks have performed so well in the past, it's easy to assume that they'll keep outperforming. But let's test that assumption. These are the 5 biggest stocks in the US as of 2024. They're all the names that we've talked about. But these are the biggest stocks from 10 years ago in 2014. There are a few familiar names on the list, Apple, Google, and Microsoft, but ExxonMobil and Berkshire Hathaway were 2 behemoths that have dropped out of the top 5 in the last decade. I mean, ExxonMobil is all the way down to number 15 today. And if we go back 10 more years, Microsoft is the only stock still on the list. And if we go back another 10 years to 1994, none of the stocks are the same, and Microsoft is the only one that's in the top 20. And all that to say, just because it was great in the 1990s doesn't necessarily make it a great stock in 2024. And that means that a great performing stock in 2024 isn't necessarily going to do well over the next 10 years. And investing in stocks is like joining a gym in January. It only works if it works for a long time. But I'm planning on investing for several decades, so my investing strategy needs to account for the changing stocks at the top. I'd hate to dump 10% of my retirement savings into a company that's not even going to be around in 25 years. Which leads us into part 2, my top investments for the next decade. We're basically faced with 2 choices on the type of stock investing we can do. Option 1, we can invest in a big basket of stocks to get a solid middle-of-the-road return, or option 2, we can take the extra risk to try to pick winning stocks for the next decade. And which option we pick and when is probably the single biggest factor in how much money we'll either make or potentially lose in the stock market. So a few years ago, there was a research paper published by Professor Hendrik Bessembinder at Arizona State University. Go Sun Devils! I didn't go to ASU, I just think their mascot is hilarious. Professor Bessembinder published this study, and he found that between 1926 and 2015, only 4% of stocks accounted for virtually all of the stock market profits during that time. 4%. That stat blew my mind, because it means if you just picked any random stock in 1926, chances are you would have lost money investing over the past 100 years, which really brings to light the catch-22 situation we're in. If you only invest in a few stocks like the Magnificent Seven, or even stocks you handpick, there is a serious risk of you missing out on the next big thing. But if you put money into an index fund that buys you a whole basket of stocks, it feels like you're leaving money on the table, seeing as 96% of the stocks won't outperform. So let's walk through when I would pick each option, as well as how I would decide what to buy right now. So if we go with the first option, the easiest way to invest in the entire stock market is an index fund or ETF. An index fund is a simple way to own a basket of stocks all at once, but you can only buy it after the market closes. An ETF does basically the same thing, but you can buy and sell it throughout the day as well. And we'll treat index funds and ETFs basically interchangeably for this video. Some of the most popular index funds track the S&P 500 index, like VFIAX from Vanguard, FXAIX from Fidelity, or SPY from iShares. They're all fairly similar, though watch out for the fund's expense ratio, the fees it costs to run these indexes. Lower expense ratios will generally cost you less money each year, so it leaves you more money to invest and grow over time. So let me show you how to buy shares in an index fund using Moomoo, who is kind enough to sponsor this section of the video. And don't worry, most brokerages will follow a similar process. So the first thing we'll do is open the app and search for the SPDR S&P 500 index. Once I bring up this page, Moomoo shows one of its best features, which is the ability to do deep dive analysis into a stock. So if you're a Robinhood investor looking to graduate to more advanced researching tools, Moomoo might be the place for you. So to buy this ETF, I'll click trade and then buy. And the most important thing on this page is the order type, where I can select a limit order, a market order, or a market on close order. Market order simply means you're willing to pay whatever price the market is at currently. You could also use what's known as a limit order if you want to set your own price and hope that someone someone is willing to accept it. As a long-term investor, I usually find that a market order is the best option unless I'm investing in a super volatile stock, and I generally wouldn't buy those anyway. I'll enter the number of shares that I want, which in this case I can buy a fractional share, so I don't have to spend $500 on this, and I'll click buy. What's cool about Moomoo is they have a bunch of tools that are hard to find on other brokerage apps, with a rapidly growing trading platform of over 24 million users worldwide. I really like this tab because it gives me a sneak peek at what are the actual holdings within this ETF. Or I can look at all the news that is affecting this specific investment. It's like a one-stop mini library where you can conduct all your investing research. But while we're talking about index funds and ETFs, it usually isn't recommended to put all your money in one fund. So the S&P 500 index gives us exposure to 500 really big companies in the US, but one of my favorite approaches is to put 1/3 into the S&P 500, 1/3 into smaller growth stocks, and 1/3 into international stocks. It's like ordering a sampler platter at a restaurant. You get a little bit of everything, and even if one dish is a miss, the rest will generally make up for it, like with stocks. So next, I'll put 33% of my money into a growth stock ETF. These are companies focused on reinvesting in growth and will often lean towards smaller to mid-size, more innovative companies. Some options for a growth ETF are VUG from Vanguard or the iShares Russell 1000 Growth ETF, both of which you can buy with apps like Moomoo. And then the last 33% would go into international stocks. VXUS, IXUX, or SCHF are all well-known options for investing in stocks exclusively outside the US. And these three funds help us make sure our portfolio is diversified. So here's when you would use a strategy like this. A diversified index fund portfolio is kind of like the GOAT of passive investing. It's probably the easiest strategy to follow, and it's a really good option for someone looking to save for retirement, since you automate your investments and you just sit back and let it grow over time. I personally like to combine this approach with picking individual stocks by putting 15% of my income into indexes or ETFs in a tax-advantaged retirement account. This saves me a ton of money on taxes while also making it something that I don't have to think about. I'll put some details in the description of some of the most popular retirement accounts and how you can use them. I personally think everyone should put at least something into option 1 for passive investing and pay your future self first out of every paycheck. But then there's option 2 for investing, picking individual stocks. This strategy is much higher risk, but also much higher potential reward, which can make it extremely powerful for someone who already has their passive investing set up but wants to invest even more, maybe to buy a house in 10 years. We'll get into more on stock picking, but Moomoo offers one of the most advanced fundamental analyses on companies. Moomoo's detailed stock page offers a lot of information that other brokerage apps don't in a free, visual way. I really like the company valuation chart because it shows you how the stock's current value compares with its average historical value. Moomoo's economic calendar also helps you keep track of what is happening in the market. So I can subscribe to see when the US's core CPI data is updated. So whether you're new to trading or a seasoned investor, Moomoo offers tools to support you through your entire investment journey, and when you sign up right now, you can get up to 15 free stocks with a qualified deposit. Here are the bonuses you can earn on screen, plus you can enjoy a limited 8.1% APY with their cash sweep account. Terms and conditions apply, and for more information, check out the link down below. What's a better way to get started investing than with some free stocks? But now that we know when to invest in index funds versus picking stocks, it's time to get into part 3, the framework that guides my entire philosophy for investing. So no matter what investments you choose, index funds, individual stocks, or some mix, this simple framework will help you maximize your profits. So I didn't invent this, it's been around for a long time, but I really like how simple this framework is. More, better, longer. Those are the only 3 ways to make more money in the stock market. Invest more, pick better stocks, or invest longer. And if you can really understand what this means, you can make a ton of money investing. But as always, the dollars are in the details. So Warren Buffett is one of the greatest investors of all time, and he only had 2 rules for investing. Rule number 1, don't lose money. And rule number 2, don't forget rule number 1. The easiest way to not lose money is to not spend it in the first place. You can only grow the money that you put into the market. So if you can save more money, you can grow more money. This one sounds kind of trivial, but if you can find a subscription that you don't use, or eat out a little bit less a week, or don't buy that new tech item you don't need, those little purchases add up. If you can invest just $200 per month for 40 years at an average interest rate, you would literally be a millionaire. $200 a month? math does that? I mean, as I was working on this video, I found out I was still paying for a Spotify subscription, even though I mostly use YouTube for music now, and that was just free money I was throwing away that I'm now throwing into the stock market. And to be clear, this isn't about sacrificing forever. It's about temporary cutbacks on stuff you're not really using anyway to set you up for long-term success, since one day your investments could eventually pay for your Spotify subscription for the rest of your life. The more you invest, the more you will make. The second way to make more money investing is to pick better stocks. And picking better stocks really means picking better businesses to invest in. The stock price is just a delayed reaction to whatever the business is doing. If Apple sells double their number of iPhones next year, the stock price is going to rise. If there's one lesson I can share that took me way too long to learn, it's that the stock really isn't that important. The stock is just a piece of paper that says you own a piece of a company. Today, it's not even that, it's a virtual piece of paper. So that's the mindset that you need to take. You're not buying a stock, you're buying a piece of a business. So to find stocks that make money, you just need to find great companies that will make more money in the future than they do today. So buying a stock is the same process as buying an index fund or an ETF. I can search for the name of a stock on my brokerage app of choice, and then I'll just go ahead and click trade, buy, and then enter the amount of shares that I want to buy. So if I want to, I could put $12 into Apple stock. So the general rule of thumb with buying better stocks is the less you know about investing, the more stocks you should own. And that sounds a bit backward, but let me explain. Warren Buffett says that diversification is a hedge against ignorance. So if you don't know a lot about stocks, owning more stocks, diversifying, reduces the risk that any one stock will fall and wreck your portfolio. So when I first started investing, I was big into solar stocks. I didn't know anything about valuing companies or picking a great business since I'd never even worked in a business. But I knew solar technology had potential. So since I didn't know which companies would win, I just bought a bunch of different solar stocks. Solar City, First Solar, SMA Solar. Some of those stocks did great, one of them did horribly, but the basket of stocks did pretty well. And that's why Warren Buffett says that most investors should really just buy an index fund, because it's a really big basket of stocks that's well diversified. And if you're someone who doesn't want to study specific businesses, well then that's a safer way to make money. But the third and biggest mistake that I see investors making is not zooming out and putting the market in perspective. It's the $5 versus $500 problem. I remember when I first started investing, I was obsessed with trying to get $5 wins. So I would buy a stock at $50 and then sell it at $55 just to buy it back at $60 and then sell it at $65. I spent a ton of time watching the markets and I didn't make very much money. But today I would much rather buy a stock at $50 and sell it at $500 without stressing about the market, because that stress doesn't help in the long term. Timing the market might work once or twice, but it isn't something that's replicable. It's just luck. In the short term, the stock market is a popularity contest. It's a voting machine. But in the long term, it becomes a weighing machine, and great businesses always end up on top. So let's look at a real world example. So Apple. I think most people wish that they could have bought this business back in the year 2000, right? Well, in the year 2000, Apple was trading for a price of $1 per share. But by 2007, it had grown to $7 per share, and people thought, it is way too late to buy now, it's 7 times higher in price. But then in 2015, the price reached $35 a share. It couldn't go any higher than that, right? But now in 2025, it is $250 a share. People will always say that a stock is too expensive, but what matters is it still a good company? So to recap, focus on investing more, pick better investments, and extend how long you invest for. But what would you do if the market dropped 10% tomorrow? Would you hold? Would you sell? Maybe buy more? So let's move on to some common fears people have when starting investing, since this is where most people hesitate and either don't invest at all or make decisions that could cost them potential gains. But with the right approach, you can avoid the biggest mistakes. So first, what if the stock market crashes? This is the single biggest fear that every investor has in the back of their mind, so don't worry, you're not alone. Stock market crashes do happen, and when they do, it feels like the oxygen has all been sucked out of the room, because no matter how good you are at stock picking, everything just falls and it feels really scary in the moment. And according to a study by Charles Schwab, there is around a 50% chance of a major pullback in the stock market each year, with 10 out of the 20 years between 2002 and 2021 seeing at least a 10% pullback in the market at some point during the year. So it's really not a matter of if the market will fall, since we know that the market will absolutely pull back at some point. So if we plan to invest for multiple decades, we need a plan for market crashes and how we can avoid losing money. So imagine for a moment that you were to buy a stock on a random day in the last 20 years, just any random day. Well, if you held that stock for 24 hours, you would have a 53% chance of making money. And I don't know about you, but I would be very cautious to bet $1,000 on what is essentially a coin flip. But now, let's say you bought that same stock on the same day, but then you held onto it for 30 days. Well, now your odds go up to a 59% chance of making money. Okay, but we can do better. If you instead held for 4 months, you're now up to a 70% chance of making money. And holding on for 2 years gets you to an 80% chance of profit. And if you extend all the way out to 16 years, you had a 99.9% chance of making money buying on any random day. So while crashes can feel scary in the moment, history shows that markets always recover and long-term investors come out on top. Time in the market always beats timing the market. But isn't investing still risky? Just because the market comes back doesn't mean your stock will come back. So the short answer is yes. Every investment inherently involves risk. But there are things you can do to minimize that risk. You wouldn't go rock climbing up a giant mountain without learning the basics first, and that feels very, very risky. But once you know what you're doing, climbing becomes a leisurely outdoor activity that people do for fun. Investing works the same way. So to minimize your risk, follow these 5 rules to invest safely. First, build an emergency fund of 3 to 6 months of expenses in cash before investing. Number 2, only invest the money that you do not need for the next 5 or more years. Short-term investing increases the risk of having to sell while the market is down. Number 3, limit your individual stock exposure. Focus on well-researched companies and avoid over-allocating into any one stock. And if you don't have time to do the research, you can always buy an index fund. Number 4, expect volatility. Stocks will often lose value temporarily, but patience usually pays off. A stock will never go up at a 45-degree angle like walking up a ramp. It'll go way up and then way down and then way up again. But long-term, good stocks will follow a good trend and bad stocks will follow a bad trend. Embrace the volatility of the market and expect it. And number 5, embrace mistakes. Learn from your investing missteps to improve your strategy. Don't let the pursuit of perfection get in the way of putting your money to work for you so that you don't always have to work for it. But okay, what do I do if I lose money? So I remember one of the first investments I ever made, I bought Skechers and it immediately dropped 10% in a week. And I was actually panicking. I had lost months of savings in a couple days. I didn't have an income at the time. But for some reason, I kept on holding the stock. Maybe I just didn't want to sell and make the loss real, but whatever reason, the stock ended up coming back. And that won't always happen. The stock won't always come back. But holding taught me the power of patience. So one tactical thing you can do if a stock drops temporarily is to focus on the big picture. Avoid fixating on your short-term losses and you can zoom out to view the long-term growth. So as an example, a lot of times a stock will go from $5 to $10 and people are super happy, but that same stock could go from $5 to $20 and then back to 10 and people are super upset. But why? You made money. It went from 5 to 10. Zoom out and look at the big picture and it can sometimes help put things in perspective. But now the most common question that I get asked with investing, how do I know when to sell a stock? Maybe I have a stock that's made some money and I want to take profits, or I'm in the red and I want to cut my losses. How do I know if it's time? So here's what I do. I don't sell a stock unless I'm no longer interested in being a shareholder in the business, or I need the money for something else, like buying a house. I don't care if the stock is up or down from when I bought it. I just care if it's a great business that will be worth more in the future than it is today. And I never sell a stock because the price seems too high or it's run up too much. But let's move on now to my one one rule for picking stocks, and I'll be sure to answer any other questions that you leave in the comments. But remember, the most important thing with investing is to start. The earlier you start, the earlier you can get the eighth wonder of the world on your side, compounding your money. And if you know someone who you want to get started investing, maybe share this video with them. Okay, so part 5. My one rule for picking stocks. If there's one thing I wish I knew when I started, it's this. It doesn't matter how great of a stock pick you are if you don't follow this one rule, which is invest continuously. It sounds simple, but let's get into it because the dollars are in the details. So first, it's better to start small and put a little bit of money into the market every month than it is to wait up and save and put a whole bunch of money in all at once. This principle is called dollar cost averaging, or DCA, and it's really powerful when it's used correctly. So let's say I put $200 into the market every month. Well, when the market is rising, I get the chance to buy stocks that keep increasing in value. So I'm super happy putting money into the market. And if the market is down, well, then my $200 just buys me more stocks for the same price. It's like shopping at a store on a discount. DCAing helps smooth out some of the roller coaster of the market and make sure your investments have the best chance to grow over time. So I actually started dollar cost averaging before I really knew what it was called. I thought it was just called investing whatever's left over after ordering pizza, but it turns out it's actually a solid strategy. But way more important than the math is there's a huge psychological advantage to dollar cost averaging. And this is something I only learned after more than a decade investing. I would much rather invest $200 per month for the next 20 years than invest $10,000 today. Not because the math equation tells me it's better, but because of how it affects me personally. Every time I add money to the market, I get to make a decision about where I invest and learn something new about stocks. Dollar cost averaging is like dating. You don't invest everything all at once, you test the waters, see how things go, and then commit gradually. Unless it's pizza, then you just commit all at once. But like the first $200 I put into stocks, I did my best, but I didn't know nearly as much about stocks as the 100th time I put $200 into the market. Investing slowly over time lets your knowledge keep pace with the amount of money you're investing in the market. This is what makes it fun and something that you can sustain for years. And if you're like me and you like learning about companies and new products and seeing how patterns repeat, well then your investments become like a scoreboard that you can use to see how much you've learned about the world and stocks. So as your money grows, you grow too. Which is super wooey, so we'll end on a really practical note. The best day to start investing was 5 years ago, and I'm extremely glad that I got in when I was a teenager. But the second best time to start investing is today. Start as early as you can and don't stop, and share this video with a friend who needs to get started investing. If you stick with it long enough, it really could change your life. And watch this next video, and I'll be answering any other questions you have in the comments.